Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Mitesco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Mitesco became a publicly traded company through a reverse triangular merger with Braintree International in 2012. From 2012 through 2015, the company's operations were not focused on healthcare services and healthcare technology. It entered that category in 2016 with activities aimed at the compounding pharmacy area and continued with technology solutions including healthcare records applications. In 2019, it adopted a strategy to develop a network of primary care clinics nationwide. The team is led by individuals who had previously managed a similar situation with a business known as Quick MedX. And that company changed their name from Quick MedX to Minute Clinic, and the focus was on convenient care clinics. CVS acquired Minute Clinic in 2006. Mitesco's approach follows a similar business strategy, but is adopting new technology and leveraging lower cost and more available healthcare staffing. The company opened its first primary care clinic called The Good Clinic in Northeast Minneapolis, Minnesota in February 2021. It has added 5 more clinics in 2021, bringing the total up to 6 clinics. If you go into a Good Clinic, you'll get complete primary care, basic behavioral health care, dermatology services, weight management, nutritional, and diabetes coaching. Patients can pay with insurance or out of pocket depending on the type of service they receive. The company is headquartered in Minnesota. The ticker trades on the OTC. Let's get started with the model. This is a micro-cap company, 43 million market cap. They're trading at 20 cents a share, and they have 217 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're not bringing in much revenue, so they have negative free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative each year. Revenue is the sales for the company, and that's pretty much zero up through 2020. They did bring in a little over $100,000 of revenue in 2021. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Then you have your operating expenses. Marketing is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income, which of course is negative every year. Below that is the interest they pay in their debt. That was about $1 million in 2021. It is lower than 2019 and 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When a company sells an asset, the profit or loss on that sale goes into other income and expenses. Then you have your pre-tax income, which is negative every year, so they don't pay any taxes. And the bottom line of the income statement is their net income, which of course is negative every year. This is the company's income statement from their 10K, and this gives us a little more info than Yahoo Finance. They had no revenue in 2020, $116,000 in 2021, negative gross profit. Their operating expenses were general and administrative, $6.1 million, negative operating income. They spent $970,000 of interest on their debt. Last year was $1.5 million. They passed through a loss of $70,000 on a legal settlement. The company applied for a PPP loan through Bank of America, and they received $460,000. A few months later, B of A notified the company in writing it should not have received that money. This company's former president had erroneously represented it was refinancing an economic injury disaster loan when no such loan had been received. It seems like this company is working out a payment plan with Bank of America. They passed through a $493,000 loss on derivatives. They have lots of preferred stock, so they pay their preferred stockholders $185,000 in dividend payments and $3.1 million in dividend payments. So their loss per share is 6 cents. Last year was a loss of 3 cents, and they doubled their shares outstanding from 105 million to 203 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. They lost $5 million in 2021. They spent $1.9 million in CapEx in 2021. These are investments in property, plant, and equipment. When they put up a new clinic, the cost for the real estate goes into CapEx, and some of the equipment they put in the clinic is part of CapEx. And those dollar amounts are put onto the balance sheet and depreciated over their useful lives. Operating cash flow minus CapEx gives you your free cash flow. They're running their business on equity and debt. They added $276,000 of debt in 2018, then $1 million, $1.7 million, $850,000. And they added a lot of capital stock in 2021, $7.4 million. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. They're not doing any acquisitions because if they did, the dollar amount would show up in investing cash flow. And the only dollar amount in investing cash flow in 2019 and 2021 is the CapEx amount. This is the operating section on their statement of cash flows. The way to calculate operating cash flow, you start with the net loss of $7.9 million. You add back the non-cash items on the income statement, $180,000 depreciation, $160,000 of amortization, the derivative liability, $493,000. The biggest one is stock-based compensation over $1 million. Then you have to adjust for changes in working capital. So they lost $5 million in 2021. Last year they lost $1.5 million. This is their investing and financing sections on their statement of cash flows. In their investing section, they bought $1.9 million of fixed assets. Last year they didn't spend anything in investing. There's a lot going on in their financing section. They added $1.7 million of common stock, $2.8 million of Series C preferred stock, $2.9 million of Series D preferred stock, another $52,000 of common stock, $850,000 of convertible notes, and they paid down $180,000 on notes. So they had a cash inflow of $8 million. Last year they just added $1.7 million of debt and paid down $171,000 on notes, which is debt. This is the equity section on their 12/31 balance sheet. They have $1.1 million of equity. They issue a lot of preferred stock, Series C, Series D, Series X. Of course, they sold a lot of common stock as well. So they raised over $24 million from issuing preferred and common stock, and they lost $25.5 million from running their business. So in order to stay in business, they're going to need to add some more debt and equity over the next few months. Let's look at the capital structure. $1 million of equity, $5 million of debt. They're 18% equity, 82% debt. This is their capital structure since 2016. And they had negative equity for a long time. Now it's finally positive after raising so much common stock and preferred stock. You can see their cash balance, the green line, is actually higher than their equity balance. But they're going to be burning a lot of cash to run their day-to-day business this year. I gave them the highest whack on Finbox, 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $176 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $127 million. We divide that by 217 million shares. And we get a calculated stock price of 58 cents. They're trading at 20 cents, so they're trading at a 66% discount. It's a buy according to the model. The forecast is for the company to hit $60.9 million of revenue by 2024. So I grew their revenue in order to hit that number, and then I doubled that number into 2025. That's how I got their future revenue estimates. The average company in their industry converts 12% of their revenue into free cash flow. So I multiplied their 2024 and 2025 revenue by 12%. That's how I got their free cash flow for those years. And I assumed they would have negative in 22 and 23. This is based on the assumption they'll hit these revenue targets. That's a big assumption. It's definitely not a slam dunk. It's a pretty risky investment. This is where the stock has been trading the last 5 years. Right in the beginning of 2021, it shot way up to over 40 cents a share. It's been cut in half since that point, but if you bought it any time in 2020, you could have made an amazing return. In the past 5 years, this stock is down 70%, while the S&P is up 91%. They have a negative beta, so the stock moves opposite the market. That means on the average day, if the S&P goes up, this stock will go down. The stock price has gone down 38% in the past 52 weeks, while the S&P is up 9%. The 52-week low is 11 cents, the high is 41 cents. And the stock is trading between its 50-day and 200-day moving average. Over 400,000 shares are traded each day on this stock. Of the 217 million shares outstanding, 197 million are on float, and hardly any of the shares are held by institutions. Their employee count has gone up a lot in 2021. That's mainly from the 6 clinics they opened up. In the past 12 months, there's been only insider buying, no selling, so that's a good sign. The general public owns 89% of the stock, 7% by individual insiders, 4% by institutions, and 0.5% by private companies. Their biggest shareholder is Mercer Street Capital at almost 4%. This company is focused on funding microcap and small cap publicly traded companies. And the next 4 biggest shareholders are part of the company, either the executive team or on the board. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They just started bringing in revenue, so they have a pretty weak price to sales ratio. And their price to book is also pretty weak at close to 40. We can't look at their price to free cash flow since they have negative free cash flow. Let's look at their non-current assets, 3.9 million of right of use assets. These are assets the company does not own, but they lease from someone else. So it's carried on the balance sheet as an asset and liability. 2 million of construction in progress. In the second quarter of 2022, the quarter we're in, they're planning to open up 2 clinics in Denver, and they have 3.5 million of fixed assets. Let's look at their non-current liabilities. There's only one, the $4 million they owe on the right of use assets. They can cover only 20% of their current liabilities with their current assets, which is a really bad sign. If a company like Coca-Cola had a current ratio of 0.2, I wouldn't worry too much because they have tons of cash flow coming in, plus they have access to the capital markets. They can easily get a loan or even raise capital by selling more stock. This company doesn't have as many options as a large company does. And since they have negative operating cash flow, they have to either add debt or equity just to fund their day-to-day business over the next 12 months. Let's look at their current assets. 1.2 million of cash, 44,000 of accounts receivables, $25,000 of inventory, and 73,000 of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. We talked a lot about this in the last live stream. Let's look at their current liabilities. They have a lot of current liabilities. They owe $4 million to their vendors. Over the next 12 months, they owe $162,000 on their leases. There's a note where they owe $588,000. Here's that PPP loan they fraudulently took from Bank of America. $169,000 of other, and they owe $195,000 of dividends to their preferred shareholders. I couldn't figure out what this $169,000 represents. OTC stocks have less stringent financial reporting standards than a stock that trades on the NASDAQ or New York Stock Exchange. In 2021, they had negative $7 million of free cash flow, and they have negative $4 million of working capital. Working capital is current assets minus current liabilities, so they're short $11 million, so they're definitely going to need to add some debt or equity over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 58 companies in the same industry as Mitesco, and they rank 52nd in market cap at 43 million. The average is 2.9 billion. And of course, their numbers look a lot worse than average because they just started bringing in revenue and they're such a small company. So it's really hard to compare them to most of these companies. So to summarize, I have them trading at a 66% discount, but this is a super risky investment. The company's really low on funds, so they really need a capital infusion to get through 2022. And it's really interesting what they do. It could really be beneficial to a lot of communities. It's not as scalable as just selling technology or selling ad space like Facebook does. It does take a decent amount of cash and time to build a clinic. You can't build hundreds of clinics in a factory like you can with a car or a cell phone. So in order to grow and scale, it is a slower, steady process. Not saying you can't do it, it just takes time. I'm really interested to see how this company does this year, and maybe I'll do another video of them this time next year to look at their 2022 financials. I ranked their free cash flows, revenue, and ratios 1 out of 10, so let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.